Welcome back to Talk Tickers. This is the show for the buy side, the sell side, and well, everyone's stuck in the middle trying to figure out where the alpha went. We are the deep dive that takes that massive stack of earnings transcripts, the 10Ks, the macro reports, all those sell side notes flooding your inbox, and we distill them down into the signal that actually matters.
That is the mission.
Today, the mission is absolutely crystal clear. We are ripping apart the Occidental Petroleum OXY Q4 2025 print. And let me tell you, if you haven't looked at the tape yet, you might want to sit down. Or honestly, maybe stand up and cheer, depending on how your portfolio is positioned today.
Yeah, it was certainly a wake-up call for the entire sector.
A wake-up call. It was a megaphone right to the ear. I mean, we are recording this on February 20th, 2026, just after the market close. And the stock didn't just beat. It ripped. We are talking a close up over 9% at $51.53. But here's the kicker, and I want you to really focus on this look at the volume.
Oh, it was absolutely massive.
Over 35 million shares traded.
Right.
For context, the typical daily volume recently has been hovering around, 10 or 11 million?
Right around there, yeah.
So this wasn't just retail investors chasing a meme on some forum. This was institutional rotation. This was the big money stepping in and saying, we like what we see.
And what is fascinating here is why they liked it. Because if you just glanced at the headline revenue number, you really might have scratched your head. I mean, they missed on revenue. They posted a negative GAAP EPS in a normal market or, with a different narrative attached to it. That stock could have easily been down 5%.
Exactly. So why the rip? That is the whole mission of today's deep dive. We are going to argue that this wasn't about the revenue. It wasn't about the messy GAAP numbers. This was a masterclass in what we're calling capital discipline shock.
Capital discipline shock. I like that.
Because the street expected business as usual, right? The street expected OXY to keep spending, to keep the treadmill going. Instead, OXY delivered a capex guide so lean, so intensely efficient, that it forced every analyst with a spreadsheet to completely reprice their free cash flow yields for the next 3 years.
It effectively changed the thesis from a growth story to a cash compounding utility story almost overnight.
So here's the roadmap for you today. We are going to break down the adjusted beat versus the GAAP noise because we have to clear that up right off the bat. Then we're going deep, and I mean really deep, into this capex surprise. Where did the savings actually come from?
Right. Is it real, or are they just kicking the can down the road?
Exactly. We're going to talk about the Simulfrack revolution that the COO, Richard Jackson, was bragging about. We're going to look at the Gulf of America water floods, which sounds boring, but it's actually their secret weapon. And finally, we are going to talk about the end game, the path to redeeming those preferred shares in 2029.
Which is really the North Star for the entire corporate strategy right now.
Absolutely. So buckle up. Let's unpack the results snapshot first. Give us the headline numbers and help us filter the actual signal from the noise here.
Right. So let's start with the bottom line. Adjusted EPS came in at 31 cents per share. The consensus on the street was sitting at 18 cents.
I mean, that is a massive beat.
It is.
Nearly double the expectation. When you beat consensus by that wide a margin on the bottom line, you immediately get attention.
You do. But then you look at the GAAP EPS, the generally accepted accounting principles number, and it shows a loss of 7 cents. Now, immediately, we need to clarify this for anyone who's just looking at a screener. This is noise.
Total noise.
This loss was driven almost entirely by transaction costs and charges related to the OxyChem sale.
Right, the OxyChem divestiture. That closed on January 2nd, 2026, so technically just after the quarter ended, but the accounting hit the Q4 books.
Correct. It's a one-time event. It doesn't reflect the ongoing earnings power of the core oil and gas business at all. So the market correctly stripped that out and focused entirely on the 31-cent adjusted number.
Now, what about the top line? Revenue came in at $5.11 billion. Last year, same quarter, they were at $5.63 billion. The street was looking for about $5.55 billion. So that's a pretty significant miss on revenue.
It is. It's about a 9% drop year over year. And largely, that's just a function of realized prices. We know oil was softer in Q4 2025. Brent was down over 9% during the quarter. OXY's realized price for oil was around $59 per barrel compared to nearly $70 a year ago.
Right.
So the revenue miss is macro-driven. It's not an execution failure on their part. It's a commodity price reality.
But clearly, looking at that 9% pop, the market didn't care about the revenue miss. And I think the reason lies in the cash flow and the production efficiency.
Precisely. Operating cash flow was $2.6 billion. If you look at free cash flow before working capital, they hit $1.0 billion.
Wow.
Yeah. In a quarter where oil prices were sliding, generating $1 billion of free cash flow is a massive statement of resilience.
And then there's production, the one thing you just can't fake.
1,481,000 barrels of oil equivalent per day in the Mboed. That beat the high end of their own guidance.
So let's pause and frame this for you. Revenue missed because oil was cheap. But they pumped more oil than they promised, and they squeezed more profit out of every single barrel than the analysts expected, hence that massive EPS beat.
It was a quality over quantity quarter, plain and simple. And importantly, they replaced their reserves. Year-end proved reserves hit 4.6 billion BOE with 107% organic replacement.
Which answers that lingering fear.
Exactly, that fear that these shale companies are just running out of rock. OXY is saying, no, we're replacing everything we produce and then some.
Okay, so that's the rearview mirror. That's Q4. But stocks don't trade on what you did. They trade on what you're going to do. And this is where the call went from good to thesis changing. Let's talk about the guidance, specifically this capex surprise.
This was the jaw dropper.
I was reading the notes from the sell-side desks this morning, and the word shock came up 3 or 4 times. Walk us through those numbers.
So coming into this print, the consensus estimate for OXY's 2026 capital expenditures, the money they spend to drill holes and build plants, was parked right around $6.4 billion.
$6.4 billion, okay.
OXY came out and guided to a range of $5.5 billion to $5.9 billion. Yeah. There's a massive delta. At the midpoint, they're coming in nearly 10 to 15% below where the street thought they would be.
That is hundreds of millions of dollars of cash that doesn't go into the ground and instead sits on the balance sheet or goes back to shareholders. But here is the skepticism, right? I can hear you asking, are they just spending less because they are drilling less? Are they shrinking the company to save money?
That is the crucial question. And the answer appears to be no. And that is why the stock is up 9%. They're spending $550 million less than in 2025, excluding the chemicals business, of course. But they are guiding production up to roughly 1.45 million barrels per day.
Which is about 1% growth.
Exactly.
Spending less, producing more. That is the holy grail of E&P. It's the efficiency kicker we're always looking for.
Right. And if you look at the breakdown of where that money is coming from, it tells a very specific story.
Yeah.
U.S. onshore capex is down $400 million. Exploration is down $100 million. And low carbon ventures, or LCV, is down $250 million because the Stratos direct air capture project is winding down its construction phase.
Let's dig into that U.S. onshore number. Down $400 million. That is a big chunk of change to take out of the Permian and Iraqis. Usually, when you cut spend that much, production rolls over. How are they doing this?
Management, specifically CEO Vicki Hollub and CFO Sunil Mathew, were very adamant about framing this. They called it a leaner, more efficient posture. But the really interesting color came from the Q&A. Apparently, back in June, when they started planning for 2026, they actually had a higher number in mind. They soft-guided higher in Q3.
Right, I remember that. The market was bracing for a much higher spend.
But between June and now, the operational teams went through the portfolio with a fine-tooth comb. They found structural efficiencies. Not just deferring projects, which is dangerous because you always pay for it later, but actually doing things cheaper.
Implication being, this isn't bill tightening because they are starving. This is structural deflation in their cost base. They have figured out how to do the same work for less money permanently.
Correct. And that leads us directly into the how. Because you can put a number on a slide, but if you don't have the operational chops to back it up, you're going to miss your guide in Q3.
Let's pivot to that. The deep dive into operational execution. Richard Jackson, the COO, was practically beaming on the call. He threw out some stats that I think we need to really unpack because they sound technical, but they equal serious money.
The biggest one is Simulfrack.
Simulfrack sounds like a video game weapon. Break it down for the non-engineers listening.
Well, traditionally, when you frack a well, you pump high-pressure water and sand to crack the rock. You do one well at a time. It's sequential. Simulfrack, or simultaneous fracturing, means you are stimulating 2 wells at the exact same time using a single fleet of equipment.
So you're literally doubling your speed.
You are significantly increasing the speed of completion. You aren't waiting for one to finish to start the next. And Richard Jackson highlighted that Simulfrack usage in their program exploded. It went from roughly 10% of their program previously to nearly 40% now.
That is a massive adoption curve in a very short time.
It is, and the math is just undeniable. He mentioned they are drilling 50% more wells per rig per year compared to their previous baselines.
50% more wells per rig. That totally explains why rig counts can go down or stay flat while production goes up. You just don't need as many rigs if the ones you have are supercharged like that.
Exactly. And they're moving from 3 to 4 well pads to 4 to 6 well pads. Bigger pads mean less moving the rig around, less downtime, more scale. It's a true industrial manufacturing approach to drilling.
And the result? Well, costs are down 15% year over year. Permian well costs down 16%, Rockies down 13%. In an inflationary environment where service costs have been really sticky for a lot of their peers, OXY is reporting double-digit deflation.
That is the competitive moat right there. While others are fighting service cost inflation, OXY is engineering their way around it.
Now, there was another piece of tech they mentioned that felt a bit sci-fi but had a really concrete payoff, the Remote Operations Command Center.
Right. This ties into the AI narrative, but in a very practical, boots-on-the-ground way. They launched a new center for the Gulf of America, complementing the ones they already have for the Rockies and Permian.
And Richard Jackson shared a specific anecdote about the recent winter storm in the Rockies.
Yes. Anyone who follows U.S. energy knows the winter storms can totally wreck production. Freeze-offs, equipment failure, roads are closed so you can't get crews out to fix things.
It's a nightmare.
Total nightmare. But Jackson said that during the storm, this remote center resolved 300 issues per day without sending a single human to the well site.
300 issues a day.
Think about the old way. An alarm goes off. You have to put a guy in a truck, drive on icy roads, fix a valve, drive back. That takes hours. It's dangerous, and the well is offline the whole time. Now, they fix it from a screen in a warm room in minutes.
So that is safety plus uptime plus cost savings. It's the trifecta.
It's what Vicki Hollub calls operational excellence, but really, it's just smart capital. Investing in the system so you don't have to invest in the emergency response.
Let's move offshore. The Gulf of America GOA. They are calling it GOA 2.0.
This is a critical pivot in their portfolio. Offshore wells are usually famous for two things: massive cash flow when they come online, and incredibly steep decline rates as they age.
Meaning they produce a ton, then drop off a cliff.
Right, but OXY is transitioning GOA from a high decline asset to a low decline asset using water floods.
Explain water flooding for us.
It's basically secondary recovery. You inject water into the reservoir to maintain the pressure and sweep more oil toward the producing wells. It flattens the decline curve. They highlighted the Horn Mountain project specifically. Injection begins soon, and they expect the production uplift in late 2027.
And the numbers on the decline curve shift were pretty stark.
They are moving from a 20% decline rate to a sub-10% decline rate by 2030.
That is massive. That essentially turns the Gulf of America from a hunting ground where you always have to find new elephants into a farm where you just harvest the crop every single year.
It lowers the sustaining capital. If your base production isn't declining as fast, you don't have to spend as much money just to stay flat. And that's exactly why they're spending $200 million more in mid-cycle projects there right now. They're investing upfront to lower the maintenance cost for the next decade.
So we have onshore efficiency with Simulfrack. We have offshore stability with water floods. This all feeds directly into the balance sheet. And this is where the financial engineering geek in me gets really excited.
It's the deleveraging milestone.
The OxyChem sale was the catalyst.
It was. Closed on January 2nd. Proceeds immediately went to torch debt. They announced that principal debt is down to $15.0 billion.
$15 billion was the magic number they've been talking about for, what, 2 years now?
Since the Crown Rock acquisition. It was the mission accomplished line. But they aren't stopping there. They launched a tender offer this morning for another $700 million, aiming to get to $14.3 billion.
And they have a long-term goal of $10 billion, right?
They do, but Sunil Matthew was careful here. No specific timeline on the $10 billion. They want flexibility in the second half of 2026. But getting to $15 billion changes the rules of engagement for shareholder returns.
Which brings us to the goodies. Dividends and buybacks.
They raised the dividend 8% to 26 cents per share. That's a clear signal of confidence in that base cash flow we talked about.
But the buybacks, the tone was interesting. They used the word opportunistic.
Yes. Unlike some of the peers, the Exxons or Chevrons, who have these rigid programmatic buybacks where they say, we will buy $3 billion a quarter, no matter what OXY is saying, we will buy back stock when it makes sense, but we have a much bigger target in mind.
The 2029 event.
The 2029 event.
Let's unpack this, because CFO Sunil Mathew specifically flagged August 2029. Why is that date circled on the calendar in red ink?
This goes back to the Berkshire Hathaway preferred equity. When OXY bought Anadarko, Buffett gave them the cash, but came with very expensive preferred shares. In August 2029, those preferreds become callable without the 110% premium.
Ah, the kicker drops off.
Right. Right now, if they want to redeem them, there's a 10% penalty, effectively, a premium. In 2029, that premium vanishes. So the strategy is clear. Build cash now, reduce the senior debt now, get the balance sheet fortress strong, and then in 2029, unleash a massive redemption cycle to take out Buffett's preferreds at par.
So they are playing the long game. They aren't trying to juice the stock in Q1 2026. They are setting up for a massive equity value transfer in 2029.
Exactly. And that requires discipline today. That explains the capex cut. That explains the opportunistic buybacks. They are hoarding firepower for the endgame.
It makes total sense. Now let's zoom out a bit. We've covered the micro, the wells, the debt. Let's talk macro. Vicki Hollub is always great for a macro take. She's usually the smartest person in the room regarding global supply. What is her view right now?
She's threading the needle. Short term, she's cautious. She acknowledged the Q4 oil price drop. She knows demand is a bit wobbly right now. But long term, she remains incredibly bullish.
She talked about the replacement crisis.
This is a stat that should scare anyone betting against oil long term. She noted that the global industry reserve replacement ratio is less than 25%.
Wait, less than 25%.
That means for every 4 barrels the industry pumps out of the ground globally, they're only finding 1 new barrel to replace it.
That is a recipe for a massive supply crunch.
Eventually, yes, physics wins. And she contrasted that directly with OXY. OXY is at 107% replacement.
So while the rest of the world is liquidating its inventory, OXY is growing it.
That's the big oil dilemma. Peers are running out of Tier 1 rock. They're having to buy expensive inventory. OXY claims to have 30 years of inventory, and here's the key stat. 84% of it breaks even below $50 per barrel.
84% below 50. So even if we have a recession, even if demand softens, OXY basically prints money.
That's the buffer. That's the margin of safety for the stock.
But there is a debate about that inventory, right? Analysts have been poking at the Permian for years, asking, are the good wells gone? Are you drilling the B-team rock now?
The secondary benches debate. It's the hottest topic in shale geology. The primary zones, the absolute sweet spots, have mostly been drilled. Now companies are moving to secondary zones. The fear is that these wells will be gassier and less productive.
And OXY's response to that?
They push back hard. They showed data saying their secondary benches in the Permian are performing just as well as the primary ones.
Is that geology or technology?
It's likely a mix, but heavily weighted to technology. The Simulfrack, the better proppant loading, they're using better techniques to extract more from slightly worse rock, netting out to the exact same result.
And then there's the Rockies transition, moving from the DJ Basin to the Powder River Basin, the PRB.
This is an important nuance. The DJ Basin is a very mature asset. The PRB is the growth wedge. It has a higher oil cut, which really helps margins. It's less developed. So as they shift rigs from DJ to PRB, you might see volume fluctuations, but the value per barrel should steadily creep up.
Before we get to the trade ideas, we have to touch on LCV, low carbon ventures, Stratos, the big direct air capture plant. It's been a cash drain. It's been a headline risk. Where are we with that?
We are finally at the finish line for Phase 1. Stratos Phase 1 comes online in Q2 2026. Phase 2 commissioning also starts in Q2.
So the spending cliff is real. They stop building and start operating.
Yes. The capex drag falls off. And interestingly, they mentioned the future model is about bringing in partners to fund capital. They don't want to carry the whole check anymore. They want to be the operator, not necessarily the sole bank.
That's incredibly bullish for free cash flow. If you can get BlackRock or some massive green infrastructure fund to pay for the steel and you just operate it and take a fee or a cut, that's a much better return on invested capital model.
It de-risks the cash flow profile significantly.
Okay, so let's summarize the setup before we get to the fun part. OXY cuts capex by 10% plus, maintains production growth, beats on earnings, cleans up the balance sheet to $15 billion in debt, has a clear line of sight to a 2029 preferred redemption, And the stock rips 9% on huge volume.
That is the setup. The market is telling you that efficiency is the new growth.
Which brings us to our favorite segment of the show. The legal team makes us say this. This is not financial advice. We are not financial advisors. We are just two voices in your headphones. Do not trade based on what we say. Do your own diligence. If you lose money, don't sue us. If you make money, send us a bottle of something nice.
Preferably aged.
Exactly. Okay, I've got 2 trade ideas cooked up based on this print. I want you to pressure test them for me. You ready?
Let's hear them.
First up, I call this the Horn Mountain Hydra. The trade is long OXY, short a pure play shale driller, someone like a smaller Permian pure play who is seeing service cost inflation right now.
Okay, so a pair trade. Betting on OXY's efficiency versus the industry's inflation.
Exactly. Here's the logic. OXY isn't really a shale company anymore. It's a carbon management and EOR utility. They have Simulfrack scale and these AI command centers that are creating a massive deflationary moat. They just proved they can cut well costs by 15%. Meanwhile, the smaller guys are fighting for frac crews and paying premium rates. Their margins are getting squeezed, OXYs are expanding.
And you get the Horn Mountain kick.
Right. You hold the long through 2027. The market thinks OXY is just a stagnant shale co. But in late 2027, the Horn Mountain water flood kicks in. You suddenly get this offshore growth wedge that appears for free because the market isn't pricing it in yet. It's a hidden growth engine inside a value stock.
I like it. It plays the dispersion. You aren't betting on oil prices. You're betting on OXY being fundamentally better at the game than the little guys. The risk, of course, is if the pure play shale gets bought out by a major, you get squeezed on the short.
True. M&A risk is very real there. But structurally, I love the spread. Okay, trade idea number 2. This one is for the gamblers. I call it the 2029 Buffett redemption arb.
Sounds exotic.
It's an EPS play. You buy long-dated calls on OXY, but you specifically target the expiration dates past the second half of 2026.
Why the second half of 2026?
Because the CFO said they want flexibility in the second half of 2026. They hit the $14.3 billion debt target in Q1 or Q2. Once that box is checked, the opportunistic buybacks accelerate. They have to shrink the float before 2029 to make the math work for the preferred redemption.
So you're betting on a supply squeeze of the shares.
I'm betting that they start aggressively buying back their own stock to engineer the price higher and the share count lower before they have to write the big check to Berkshire. You basically front-run the corporate treasury.
A flow-driven trade. If they execute, that buyback pressure puts a hard floor under the stock and drives multiple expansion.
Exactly. It's the endgame trade.
Well, as always, wild but very plausible.
That's the Talk Ticker's guarantee. But before we wrap up, I want to leave you with a final provocative thought, something to chew on that wasn't explicitly on the call, but it's the logical conclusion of everything we just talked about.
Let's hear it.
If OXY has effectively decoupled their capital spend from their production growth using AI and Simulfrack, what happens to the rest of the service sector? Does the traditional oilfield services model completely break if everyone else is forced to copy OXY's efficiency just to survive? If you need 50% fewer rigs to get the same oil, that's a structural crisis for the guys renting out the rigs.
That's a great point. Efficiency for the driller is a demand shock for the service provider.
Exactly. Keep an eye on that dynamic. I think the recap for OXY is simple. They delivered the holy grail of E&P earnings, lower spend, higher production, rising dividend. The 10% capex cut versus consensus is the story. That's why the stock is up.
And the deleveraging is effectively mission accomplished. They hit the 15 billion mark, the emergency phase is over, and now they are firmly in the optimization phase.
Management stopped chasing growth and started chasing margin. And the market reaction confirms that investors want efficiency, not just barrels.
Keep an eye on the Powder River Basin transition. That's the next big operational test. And watch for the Stratos startup in Q2. If that goes smooth, another major overhang disappears.
Absolutely. This was a pivotal quarter. If you were short, I'm sorry. If you were long, congratulations. And if you're stuck in the middle, well, hopefully we just gave you a map.
Indeed, we did.
That's it for this deep dive into OXY. Keep your stops tight and your laterals long. See you on the next print.